Good morning, everyone. It's Investment Tuesday. And today, of course, I am going to talk about what everyone wants to talk about, which is tariff wars, the stock market crash, panic, sell off, correction, whatever you want to call it. Yeah, we're going to do that. And I'm going to give you my perspective, which is slightly different than what most people are focusing on. And then I'm going to talk about Bitcoin very quickly. And then I want to talk about one crypto that is clearly showing signs that it does not care about the tariff wars, does not care about the stock market sell off, and is, clearly being bought. And I'm going to lay out why I believe that is. All right. Okay. So first, let me, before I do any of this, go into my legal disclaimers and disclosures, which is that this video and the content from ATG Digital is not investment or financial advice. It is presented to you as opinion. Use it as information, engagement, entertainment, whatever you choose to do with it. It is your responsibility because it is your money. All ATG Digital content may contain errors, oversights, or mistakes. Understand that investment operations, which means buying or selling a stock, buying or selling a call or put option or crypto, has significant risk and can lead to the loss of your principal. You are not guaranteed to make money just because I am making a video about it or because ATG sends you a trade from one of our model portfolios. Next, I, the owners, employees, contractors of ATG Digital, own, trade, transact the securities that are mentioned in this video and all content from ATG Digital. Next, we do not take money from companies or crypto sponsors, promoters to recommend their stocks or crypto tokens. This is something that is now widely done by people on YouTube, influencers, whatever you want to call us. So for better and for worse, for gain or for loss, what you are getting from me, from us, is our independent, unique point of view. We put out a lot of free content. The Substack goes out daily, and a lot of what I am saying today about the tariff wars, the panic in the stock market, is there in today's Substack. I highly recommend you subscribe to it because it gives you a running counter of what I am seeing in the world, and then so also our team that writes about specific opportunities that are in our portfolios currently. I also have a podcast on Spotify called Bald Man Speculating, focuses on investor psychology and macro. It comes out at least once a month. So subscribe to that. And then finally, I'm on YouTube right now. I'm here every Tuesday, and periodically, sometimes I just show up. I am very active on X, previously Twitter. Instagram has been a little passive recently, and we are sometimes active on Facebook. But you can follow us in all of those places. We do have paid subscription services, which take the form of tiers, not from your eyes. Tiers meaning like levels. There's silver, gold, diamond, platinum, and purple. They offer you access to model portfolios, trades, updates, etc. Please go and check our website, atgdigital.media, to find out more and see if one of those is right for you. They are monthly subscriptions, so you do not have to make a yearly commitment. You do not have to make a lifetime commitment. It's monthly, so you can come in, check it out, see what you want, and go from there. But let us get to the matter at hand, right? Which is that the stock market, after seemingly that it was bulletproof and incapable of falling, has just suddenly come apart at the seams. And the proximate cause for this, explosion, eruption, correction, sell-off, crash, panic, all the words can apply, is the tariff wars. Now, there are plenty of people making YouTube videos about tariff wars and, why, the how, the what, the when. I am going to focus on what I look at, which is, for me, yes, that's all true, but those are narratives, right? For me, prices are set by demand and supply. And so the critical factors around demand and supply are what? Investor psychology, dealer positioning, investor positioning, and then, of course, the business values that that are there, right? And for some time now, I have been writing in my Substack and talking about in my podcast how the big indices, the S&P 500, the NASDAQ 100, have problems with it. I mean, right, major problems. They are trading for historically very high levels of valuation, which means the prices are very high. And then internally within these indices are triggers that in the past have been triggers for, sometimes crashes, sometimes bear markets, sometimes corrections, depending on, how long it goes. And today I want to tell you that, hey, yes, you can go and listen to endless amounts of stuff about the tariff wars, and maybe that will help you. But in my opinion, for the time frames that the vast majority of you actually operate in, you are not business owners. You are a price speculator. Let's just all admit it, right? We are in the stock market to see gains. If you are in the stock market to see gains, you are not a business investor. A business investor is focused pretty much on financials, and like a private company, they don't worry about what the value of the company is. They're focused on their business operations. But we, as price speculators, we are deeply concerned about the price, right? And those are the things that I focus on. And those things are driven by demand and supply. Those things are driven by the juxtaposition of how people are positioned, view events, news, rumors, innuendo, etc. Right? That's what drives the shifts in prices. And of course, we like prices to rise and go up to the right as fast as possible. And when we think that's going to happen, we put ourselves in a position to try and get maximum advantage from that. When it doesn't work out, we're not quite sure what to do, right? I mean, because if I'm right, a lot of people have come into the stock market over the last 1, 2, 3, 4 years, pretty much since the COVID crash. I believe you've seen a huge number of regular individual investors, retail investors, whatever you want to call people. They've come into the market, and they have bid prices higher for certain stocks. And and it's very easy to tell what these stocks are. For the most part, like the largest amount of money will have gone into the most popular, well-known, talked about, written about, posted about, social media about stocks: Apple, Amazon, Google, Meta, Tesla, Nvidia, AI stocks. And then from there's others. And that's where a lot of the issues lie, right? Which is people are very, very focused, concentrated, over invested, over own these popular, well-known companies. And they've done it in a certain way that has driven the crash phenomenon, behavior that we are seeing as a result of the tariff news, events, whatever you want to call it, right? So I'm going to talk about 3 things that I believe, if you're a price speculator, and even if you don't think you are, I'm going to say you're probably kind of deceiving yourself, being that we're all interested in the short-term price for the most part. I mean, other than, people like Warren Buffett who are invested for 10, 15 years, the vast majority of us, we want our accounts to go up. We don't want them to go down, and we want them to go up now, right? So that puts you in the price speculator. So whether you agree, disagree with me or not, you're really in, this analysis applies to you. All right. So the number one issue really around tariffs that is not being talked about is, it's not about the global trading system. It's not about Europe or China. It's really about where companies that dominate the S&P 500, that dominate the NASDAQ 100, these are indices, they're also investable portfolios. The companies that dominate it, they get their profits. And I'm going to put this tweet up, or X post up. that on this, because I think this gets to the heart of the point number one, which is that we can debate interest rates, we can debate recessions, we can debate the fairness of the global trading system, we can debate President Trump's various actions, all these things. But the primary issue really here is that many of the companies, and we're talking about the Mag 6, and it extends more, the companies that dominate the S&P 500, that dominate the NASDAQ 100, so those are the ticker symbols, SPY, QQQ, they benefit from certain forms of labor cost, tax, and regulatory global arbitrage. In other words, if you ship your operations to China or to Mexico or someplace that has lower labor costs, you make more money. If you domicile your operations in tax havens, you make more money. If you go and put your particular operation where there are fewer regulations on the environment, fewer regulations on labor, fewer regulations on income or anything else, you make more money. And the companies that dominate the S&P 500, the NASDAQ 100, yeah, they are the ones that do it the most and earn the biggest profits. So while you can spend a great deal of time focusing on all of these things, I can tell you that the number one thing that you need to understand is that this sell-off, this crash, this panic, this whatever you want to call it, right, is not about interest rates. It is about the fact that big investors, big money investors, understand what I am telling you, which is that the Apples of the world, the Amazons of the world, the Metas of the world, the Googles of the world, they use this form of labor cost, tax, regulatory global arbitrage, and it allows them to earn huge, massive profits. And in a new trading system, those profits are not going to be as big. They are going to be smaller, and they are going to be smaller by some magnitude. We don't know exactly by how much, but whatever it is going to be significantly smaller than whatever people's expectations were in 2024. And likely it's going to be at least a bit smaller, or enough smaller that there are enough people that want to sell these stocks out. I have recommended this source of information to you before, Wolf Street. This is written by a man named Wolf Richter, and he lays it out as very clearly as you can see, which is that while people are focused on news about the tariffs, the real issue is profitability. And he lays it out in that headline, which is that stocks plunge as the market understood what tariffs are. They are a tax on corporate profit margins. In other words, the biggest companies that dominate the S&P 500, that dominate the NASDAQ 100, and that dominate trading, both for for the US markets and for most investors. We're talking about Nvidia, we're talking about Apple, we're talking about Amazon, we're talking about Google, we're talking about Meta. All those companies, their profit margins, and that means their profits are going to go down. 2025, we'll see something smaller than 2024. 2026 will in all likelihood see something smaller than 2024. And investors who now are like, okay, there is no more doubt, there is no more uncertainty, this is going to become a reality, are going to try to anticipate, forecast, or look forward what those are. And they're like, I don't think I really want to own these companies, or else I don't want to own as much of these companies. And they are selling, right? So that is like the initial trigger point, if you will, which is that there is a clear, committed, and large seller in the market for the companies, the biggest companies that dominate the S&P 500, that dominate the NASDAQ 100. All right. So there is a large, clear, and committed seller of these stocks, right? And into that environment, we have a lot of retail traders, individual traders, new traders, new investors that have piled in to many of these stocks or piled into trading these indices through these ETFs, SPY, QQQ, with borrowed money. What is margin debt? Margin debt is borrowed money. In case you didn't know, and I am just going to show this. That's the margin debt numbers. Margin debt is you borrowing money against your stock portfolio. Most brokers offer this as a service. Stocks are an asset, right? I mean, a wildly fluctuating asset, but they're an asset. And when prices are going up, as they have been in 2024, very fast, very rapidly, and in big amounts, people get pretty excited and they're like, I'd like more of that. So they start to borrow money to own more, which has a cascading effect of bidding up the index, bidding up the stocks that dominate the index. And now you have this cycle of price gains driving more borrowing, borrowing driving more price gains, and etc. And guess what? We are just coming off an all-time high in terms of margin debt. All right, I'm just going to shorten this, and you'll see in January we hit a high of $937 billion and change for margin debt. Remember, margin debt is money that is borrowed against stock portfolios, and that beats the previous record, which was in October of 2021. So why am I bringing this up? Why am I bringing up margin debt? One, because from my 30 plus years of experience, margin debt peaks and market peaks are often coincide with each other. And margin debt tends to create fragile markets, tends to create delicate markets. Why? Well, when you borrow money against your stocks, you are on a margin, and they will not give you, 100% against the value of stocks. Every stock is rated. Sometimes they'll give you a 30% loan. Sometimes they'll give you a 40% loan. Maybe they'll give you a 50% loan. But the biggest companies like Apple, Amazon, Google, Meta, etc., you can get as much as a 70% loan. So the greatest amount of margin that we will have seen, and I'm just going to go back to 1 year, you will see that from this, I'm going to 1 year. Yeah, there we go. From sort of about August of 2024, when we were at 797, let's round it out to 800, to here, we've seen about $118,000 worth of new margin debt put on. Knowing how margin works, well, the vast majority of that would have been borrowed against either index ETFs, SPY, QQQ. How do we know those two? Because those are the ones that have gone up the most. Those are also the most liquid. Those are also the most where you can get the greatest amount of margin. They would have also gone up in stocks like NVIDIA, Apple, Amazon, Google, Meta, the Mag 6 tech, if you will. Why? Well, they had the biggest gains. They'll also give you the biggest amount of bang for your buck in terms of borrowing margin. And that creates a very fragile, delicate market because you have to keep a certain balance, right? I mean, if your NVIDIA stock drops by 15 or 20% and it is owned on margin, you either have to put more cash in or else you have to sell some NVIDIA, right? Or you have to sell some Amazon, or you have to sell some Apple. And so I believe, especially when you look at the price action last week, what you are seeing is margin calls being exercised. In other words, people are getting notes in their brokerage accounts and be like, hey, your margin account is out of balance. You either need to add cash or you need to sell to bring it back into compliance. And if you don't do that, then the broker will do it for you. And you have no choice. They will sell out literally your entire account if they need to bring your margin account into compliance. By law and by regulations, they are required to do that. So yes, the tariffs are a major issue, no question about it, right? But there's a misunderstanding here as to why that is. People simply think it's the macro panic. No, the macro does drive a certain macro issue, which is that the profits of the biggest companies that dominate what people own through the big indices are directly tied to what is changing. In other words, they made a lot of money by using the globalization system, if you will. And that globalization system is either going away or essentially being turned in such a way where they're not going to make as much money at a time when people very optimistically have gone and borrowed record amounts of money to own those precise stocks that, are now beginning to be re-rated or being re-rated by big investors who are like, hey, the world system is changing, the world trading is changing, and it means that companies that benefited from that old way, they're not going to benefit as much, or else they actually might, have some issues, serious issues, and we want to sell. And as they sell, people own too much of these companies. People own too much of the S&P 500. People own, and when I say, people own too much, I mean short-term traders, price speculators. They own too much, and they own it with borrowed money. So as selling happens, at some point it triggers these margin calls, and people are just being sold out because they don't have the cash, and their bets are coming undone. Now, while this is going on, you also have this issue, which is that the S&P 500 is at a record level of concentration, right? The top 10 stocks, and it's dominated by the Mag 6, 7, but it extends itself out. If you go to the top 20, it's even more, but 38% of the S&P 500 is in 10 stocks, right? So this is not a very diversified index. This is a undiversified index, right? It is very dominated by big tech stocks and generally by the very largest companies that operate in the United States. That's kind of how they've become overvalued, overowned, overpriced, and also become the subject of huge speculation with margin and borrowed debt. The other index that I reference, the NASDAQ 100, I couldn't find a headline, but I can show you this, which is that the top 10 companies in the NASDAQ 100 represent 48%, nearly half of this index. In other words, not very diversified, right? Not very diversified. And it's the same companies that dominate the S&P 500. So you've got the most traded ETFs, baskets, indices, portfolios, if you will, in the same companies, owned in a significant way by many individual retail investors, trading at very high prices with borrowed money. That is a recipe for what we have seen. In other words, we've seen stock prices crash, and I will just quickly get the current market going. Like if you go and look at the behavior of let's look at the S&P 500, since I've been talking about this. Look at, I want to make sure that I'm showing the same thing. You see this, what I call a waterfall decline. What is that waterfall decline? Let me go back to the chart that I was showing here. The waterfall decline is this. In other words, prices open up nowhere near where they closed the day before, right? There's an open price, which starts at 9:30, and the prices are significantly lower. In my experience from being around markets in 2008, 2020, and even previous crashes all the way back to 1999, 2000, this is driven by margin calls. In other words, people are being liquidated, forced liquidations. And if I put up the NASDAQ 100, I'll put up the ETF, you will see the same thing. In other words, very highly concentrated positions with leverage and margin debt are being sold out. And what it's doing is that it's driving additional selling, because once someone sells for a lower price, now if there is a stop loss, if there is another trader investor that has also used margin, but let's say, they had more of a profit and they could hold on. Now, slowly that investor is also near the liquidation price. So these things tend to cascade upon each other. And I will say that is, while the tariff is the news, if you will, that is driving the sale, the immediate catalysts really are that we had a huge run in 2024 that got a lot of investors very excited. They were like, hey, I want more of that. They said, I'm going to get in. And as those positions generated profits, they borrowed against those positions and bought even more, and into a major event driven around the global trading system, if you will. Yeah, there's big sellers who are willing to accept lower prices. And that started, obviously, the peak was in February for the NASDAQ 100. And as they started to sell, eventually liquidity ran out. And now there were many, many exposed investors on margin with borrowed money that are being liquidated out of the market. Okay, let me make some last observations before I move to the next thing, which is that this is a chart that is comparing various indices for 2025, right? And there are some interesting observations here, right? The Russell 2000 is 2,000 companies that trade in the United States, and they are the smaller 2,000, right? I mean, so this is a small cap index. Cap references market capitalization rather than the stock price. In other words, what's the size of your company, which is calculated by multiplying the share price and the number of shares. So that's an index with all the small companies in the United States, approximately. It's not perfectly true, but approximately. And that index is down about 19% year to date, right? The S&P 500 ETF, so that's the green line, that is SPY. This is the default index. It's referred to most people as the market. It's what people invest in if they want sort of like exposure to U.S. stock markets. People will buy this. That's down 14%. Then we've got the NASDAQ Composite Index. This is all of the stocks that trade on the NASDAQ stock exchange. Most of the big tech stocks trade there. That's down about 20%. Then we've got the equal weighted version of the S&P 500. Right now, that is down 10%, which is while 14 and 10 in a market panic may not seem like a lot, but still, it's a meaningful thing to notice that two versions of the same index are having quite different performance characteristics. What is the difference between an equal weighted version of the S&P 500 versus SPY? Well, SPY is a market capitalization driven index. The simple way of putting this is that the biggest companies have the largest weight. Equal weighted ETF means that it doesn't matter how big you are, you get the same amount. In other words, if you got 500 companies, everyone gets a 0.25% weight, right? So it, by its very nature, emphasizes the smaller companies, while by its very nature, the market capitalization based SPY emphasizes the larger companies. And for the better part of, I'll say 6-7 years, if I would extend this chart out to 2016, the bigger companies have benefited in a very significant way in the stock market and also in the economy, and their prices have been bid up. But into this sell-off, crash, panic, the smaller companies that are in the S&P 500, which are, a minuscule amount. I mean, if you have 30% of the S&P 500 in 10 stocks, the remaining 490 can't be that much, right? So the smaller stocks are doing better. In other words, despite being seen as being riskier, as having underperformed, people aren't selling. And I don't think that's the actual reason. It's not that people aren't selling, it's that nobody really owns it. The vast majority of money really is invested in the big stocks. And as the selling goes, these smaller companies are so small, they're almost negligible. There's almost like very little selling that there is to be had, and which is causing the equal weighted version of the S&P 500 to outperform. Finally, we have the QQQ, which is the NASDAQ 100, which is the biggest companies that trade on the NASDAQ 100, and that's down about 17%, which is greater than the S&P 500, SPY. But again, the equal weighted version of the S&P 500 is doing better. I don't believe there is an equal weighted version of the NASDAQ 100, but I believe that it probably would be doing better as well. All right. So bottom line from the tariff crash, panic, sell-off, correction for me is this, which is that it is a function of where markets are. It is a function of investor positioning, and also understand that the old catalyst for markets moving up, which would be everybody would be focused on interest rates, is not as much in play because of what I mentioned earlier. In other words, if you are focused on interest rates and buy into rallies driven by interest rates, you're likely to be disappointed because the sell-off is driven around profits. In other words, people who understand what's going on are like, hey, the big companies that trade in the United States have disproportionately benefited from globalization. They dominate the indices, and their profits are going to be lower in the future. And we want to sell these companies, right? And so interest rates can go down, but nothing really changes for the underlying reason why they're selling. In other words, they're selling because they're anticipating lower profits into the future, and that the current system that's being put in of tariffs, etc., is not as positive, not as good, potentially negative for all of these companies. So interest rates going up and down is not a critical factor, is not a critical catalyst for what is driving this sell-off. So don't get trapped in thinking that, hey, there's news about interest rates going up and I'll buy in. Yes, we will definitely have some rallies when that news comes, but it doesn't change the motivations of these large committed sellers. They are like, hey, we own too much of these stocks and we are going to keep selling, right? In my Substack today, I talk about, how long will this go on? What is the end game here? Well, as you know, I focus on demand and supply, right? So the reason why prices keep going lower is because there are sellers, whether it be the big committed sellers who are selling because they understand that profits are going down and the global trading system is changing. They're like, hey, I really kind of don't want to be in all of these things. I want out. Meanwhile, we have retail and individual traders, speculators, investors that own too much of these same stocks on margin. They want out, or they're going to end up getting sold out. And we need the folks who are selling to either be exhausted out and sold, or else for prices to get to such low levels that buyers come in and be like, yeah, irrespective of the trading system, irrespective of where profits are going, these stocks are such bargains, either in the short term or in the long term, that I don't really care. I'm going to come in and buy. That will then set the bottom, right? So how much is that? I mean, well, if you go by some things, which is like I brought up 2 or 3 things. Well, one way to track this would be keep looking at profit estimates for the S&P 500, and in particular for these, big companies. When the estimates start to bottom out, that will be a signal, because big investors are forward looking. They're like, okay, these have bottomed out and these are gotten so low that it's worth taking the risk, right? So that's one way of tracking things. Second, is to go and look at these concentrations. 30% of the S&P 500, 48% of NASDAQ 100. If it starts to get to, 28, maybe 25, maybe it gets to 22, whatever, you're going to get to a point where the concentration now simply has less of an effect on these indices. And that will be another point where the downside momentum is sort of broken. And now, whether it be price action, whether it be estimates, maybe it's investor psychology is like, yeah, this has gone too far, too fast. Yeah, there's too many people who are short. We can come and squeeze them. For whatever reason, people will come in and come to buy. And the third thing is the margin debt comes down because people have been liquidated out. And now there is less fragility, less instability. Markets, are a little bit, stronger and less delicate. So those are the three ways to determine, like, hey, when does this end? If people, of course, want like a time frame, I would say it's going to be driven very much by investor behavior. If people keep buying the dip in these very large stocks, then it will extend out some more. Because if I'm right, and remember, this is my opinion, it's not fact, it's not coming up from above, it's my opinion. Yeah, there's, committed sellers of big money are, is selling these stocks. You've got very weak holders holding it with margin debt. Yeah, they're going to get churned out, and then that extends it a little bit lower. What we want is really, for that margin debt to disappear. We want for that concentration to kind of be lowered, and that can happen in two ways. The prices of the bigger companies can go down. The price of the smaller companies can also go up, and we are seeing a little bit of that. As I said, the equal weighted version of the S&P 500 is doing slightly better than the cap weighted, or the, where the size is the biggest issue, version of the S&P 500. So that can happen. And then the third is just people coming to certainties, like once, let's say, the US and China, or US and Europe come to some sort of agreement, hey, this is going to be the new shape of the trading system. People then come to like, okay, excuse me, earnings for 2025 and 2026 will be whatever, 5% lower, 7% lower, 8% lower, 10% lower. And once that becomes more clear, now the reasons to sell kind of like start to disappear. And into that, we will see rallies, maybe a bottom, whatever, however it turns out. But in the end, remember, everything is not just driven just, like, hey, it's this. It's driven by some combination of what investors are doing, which is driven by investor psychology, market positioning. In other words, how are markets positioned for it? Very high prices just generally tend to be vulnerable to news that, doesn't confirm whatever the viewpoint was when, people put those big trades on, right? And then there's the actual, actual facts. In other words, if there are deals struck with the big trading partners, the EU and China in particular, that will set the template, for trade deals with everybody else. And with that, the market uncertainty will go away. So is it possible to say with certainty, like when this is going to end? Not yet. If I were to guess, I would say that there is no real positive good that comes out of extraordinarily, volatile markets. Not for President Trump, not for anybody else, not for China, not for the EU. No one really benefits because, the Chinese market dropped by 13%. European stock markets, which were going up, earlier this year, are now all, going down. So nobody really benefits. In other words, it's in everyone's interest to come to a deal sooner rather than later. I doubt that's going to be days, but it could be weeks. I would say the longest it takes is a couple of months. And so in my Substack, I lay out maybe it's, end of April, early May. I'll say, maybe June. That's the time frames. And we will see some bear market rallies. We will see some, some huge moves. In fact, today before recording, there were some crazy moves, right? We were the various indices were down 1, 2, or 3, almost 4%, and suddenly, they ripped higher by 2 or 3%. So this is pretty reminiscent of, the kind of trading we saw in 2008 when, these indices are unmoored from asset values. They are just purely going by sort of the positioning of dealers, very large hedge funds that are either trying to hedge their positions or cover their short positions. In other words, it's not really reflecting what's going on other than sort of like an event betting around like, hey, when does this uncertainty end? Do we want to go long? Do we want to increase our shorts? Do we want to reduce our shorts? And that can push prices up and down by huge amounts intraday, and from day to day and week to week. I would tell you this is a perfect environment in which if you are buying, to start slow, to go slow, and to buy, into low prices. In other words, when you least want to buy, when it feels terrible, that will be a good day to buy, right? So small positions, do it slowly, dollar cost averaging, and pick days, where it's like you see a negative 5 or 6% day. It may not be the bottom, but nonetheless, later on, right? 3 years, 5 years from now, stock dependent, of course. Those could turn out to be great prices, right? I mean, I do want to share one more tweet before I move on to Bitcoin, X post, I should say, which is that buying the dip depends on what you're buying. If you're extrapolating the last bull market continuing, in other words, Mag 6, Mag 7, tech, etc., my experience is that that's likely going to be a bad bet. Old bull markets like the one we've had, and this is my opinion, I know people will disagree, and you are entitled to your view. There's no need to come and harass me or troll me because I have a different viewpoint. You can have your viewpoint. My role here at this YouTube channel is to convey mine. You can take it, you can dismiss it, you can send it through this year, out the other year, but that is my viewpoint, which is that old bull markets kind of get old at some point. And it happens when they get bid up to the point where there's simply too much stock. And the prices then start to fluctuate until sellers either find it unworthwhile to sell or buyers find it so attractive they can't help but buy, right? I've kind of gone through all of this. And the part that I haven't gone through is that the new bull markets are almost never where the old bull market was, right? After the 1999-2000 tech bubble burst, we had a kind of like a value-driven market, and then there was also the commodities market. There was a bit of a gold market. There was like the housing finance market. That's what took off, right? I mean, after 2008, those old ones, didn't really do much. Instead, we really had a market driven very much around sort of like, smaller technology companies like Netflix and, the whole FANG trade, etc. That's where, it got created. So the new bull market is going to be in a different place than the old one. And in ATG Digital portfolios, we're buying electricity, natural gas driven stocks, drones, insurance, gold. I believe this bull market will extend out into crypto, biotech, genetics, fintech. And the basic reason for that is that they have the opposite dynamic to the old one. In other words, people don't own these stocks, don't own these sectors, don't own these groups. And so there's latent pent-up demand, right? In other words, people come to buy. And as they come to buy, the people who bought early, they won't sell. Instead, they'll be buying more. Why? Because, we want more gains. That's natural human psychology. And this combination of old holders holding plus new buying causes prices to get bid up, and prices then get marked up by dealers as they see the demand. Now the whole cycle starts to go in the correct direction. We're clearly not at that point yet, but sooner rather than later. I don't think this is going to last, 2 years, right? I don't think this is going to be a bear market that lasts years. I think it's going to be months at the latest, potentially weeks from now, because it's in nobody's interest for this to continue. So that's my view of the stock market. Now let me go on to Bitcoin before I go on to one crypto that is, I can't say it's directly benefiting, but there is something definitely going on that benefits them, and they are a unique beneficiary of this shift. And I believe that the tariff wars, which are going to lead to currency wars, etc., they benefit from it. But before I get into that, a Bitcoin update. Two things I want to say here, right? Which is that we are seeing the first signs, nascent signs, that the market for Bitcoin is shifting ever so little from being a asset that is owned primarily for price upside, in other words, speculation, to where there are people who are like, hey, I kind of want to own it like gold. In other words, I don't really care about the fluctuations. It's there as a hedge. It's there as a kind of like a counter position to things whose values are like swing up and down relative to global trading systems, relative to earnings or anything else like that. We are seeing the first signs of that because Bitcoin is no longer just going one for one with NASDAQ or tech stocks. And Bitcoin price, let's see where it is today, is at 78,000. And in a different time, in the 2020 COVID crash, Bitcoin went from 10,000 to like 3,500, like that, right? And even in 2022, we had similar behavior. But Bitcoin is no longer going and correlating with NASDAQ tech stocks as much anymore. We are seeing the first signs of people using it as a hedge asset, right? And from a price perspective, right, I'm always focused on something that the vast majority of Bitcoin commentarists, is that a word? I don't know. Whatever, the folks who don't talk about, which is the cost of mining Bitcoin, which ultimately drives whatever people are going to pay, right? And right now it's costing about $84,000 to mine a Bitcoin. And the market price is about 78,500 approximately, right? Bitcoin price trades relative to this cost. Sometimes it can trade at a significant premium. Sometimes it will trade at a significant discount. Sometimes it will trade at a modest discount. Right now it is trading as an 8% discount. Now, if I am correct, which is that Bitcoin's market is expanding from folks who own it primarily for speculation to also people who are using it as a hedge. I mean, and it's true in gold as well. There are people who own gold for speculation, in other words, price increases, and they own it as a hedge. The folks who are coming in to buy it as a hedge, they are long-term holders. In other words, they're like, I want a 1% position in Bitcoin, and it is there as a hedge against the financial system, just going off the rails and, something terrible happening. In that scenario, I want to own Bitcoin. And if there are more people that start to feel this way, now they are starting to become a larger part of the Bitcoin market. And into the post-halving supply shock period, which we are now we're about on April 19th, we'll celebrate 1 year since the halving. They will represent upside bid up demand for Bitcoin. So they will start to come in and buy Bitcoin at 8% discount. It's possible that Bitcoin could go lower. I mean, I'm not guaranteeing that this is the bottom. Could go lower, but nonetheless, there are buyers who have a different point of view. They're not buying it purely for speculation. They're buying it as a hedge against the global trading system, against the global financial system. They're like, this is independent. The Bitcoin is not issued by any central bank. It's not associated with any country. It is simply this electronic currency that has its own independent properties. It is also independently issued. It has nothing to do with anything. Yeah, I want some of that. And in my opinion, the beginnings of the lack of correlation versus NASDAQ are indicating that those folks are starting to come into the Bitcoin market and starting to accumulate it. They're not enough size to, have it be like higher, but consider the environment. I mean, there's a global panic going on, right? I mean, and people are selling risk assets. What's a risk asset? Anything whose price fluctuates a great deal. Cash doesn't fluctuate a great deal. It's stable. Gold's price fluctuates, but nonetheless, people look back on its history and its use as a store of value and be like, well, the fluctuations don't matter. I own it for a hedge. Yeah. Bitcoin, ultimately, I believe, it's going to gain market share for those folks. And I believe the beginnings of it is happening right now. If that's the scenario, into whatever market stability comes and when it comes, I believe that, a mixture of like folks coming to buy it in a big way, here interest rates would matter. If the Federal Reserve were to cut interest rates and liquidity surged into various markets, Bitcoin would be one of the big beneficiaries of that. So I would say, if you're out of Bitcoin, now might be a moment to go get some exposure. It's not that it couldn't go lower. Nonetheless, the conditions are ripening for where there's new buyers emerging. There's already scarcity post the halving. We're coming up on the 1-year mark. And sooner rather than later, the Federal Reserve is having an emergency meeting today. They're likely going to cut. And some of that liquidity is still going to want some hedge, something that like, hey, I want something that's scarce, that's finite, that's provably scarce, kind of like gold, because I think there's going to be greater uncertainty in the global economies for some period of time. And that's what a hedge asset will give you. All right. So that is the part about Bitcoin. All right. Now, finally and quickly to one crypto, and let me see. So there is something called a stablecoin, right? And the simplest way to define a stablecoin is like a digital money market fund, right? What it allows you to do is use digital blockchain technology to send money, right? I mean, if I wanted to send money, for example, to my mother in India, if she had a Coinbase account in India or something that allowed for the acceptance of tokens, of digital tokens, I could take my phone and send her whatever, $10 or $100, and it would be there in minutes, potentially seconds, right? Quite different than if I wanted to use the old school banking system to send her money. Then I'd have to go on to services like Western Union or Wise or one of these things. And then, I'd have to pay 20% of whatever I'm sending. I have to give as a fee. And it would probably get there in 1 or 2 days because the money has to come out from my bank account, then go into their account. Then from there, it has to go into a country-specific account. And then finally, from a country-specific account, in India, it would finally get transferred to my mother. And on the way, everybody's taking a fee, right? A stable coin sort of like simplifies all of this. So you can essentially be your own money transfer agent. You just go to your Coinbase account or whatever account you're using for crypto, and you just simply get, I would get my mother's wallet address, and I would just be able to send it to her. And it would happen like this, and it would happen right now for almost no fee. And if you keep your money in these stable coins, they will give you better interest rates than the vast majority of banks. My bank, I think, which is Wells Fargo, gives me, I don't even think it's like 0.5%, I think, in my savings account. I have an account with Fidelity, and their money market gives me a more competitive rate, but savings accounts don't really give you anything. Now, I mean, savings accounts are, FDIC insured and much more regulated. Stable coins, we don't yet have regulation, but nonetheless, in many parts of the world that don't have access to US banking system regulations, don't have access to dollars, they are using stable coins in a fairly big way. And increasingly, in the United States, people are starting to use stablecoins. Why? Well, it's cheaper to transact in. You can buy and sell. You can send money to somebody, whether it be your mom. I mean, if my kids, I can send it to them much easier. Happens, in other words, very quickly. Second, it's a lot cheaper. And third, if you keep your money in stable coins, they're like, we will give you 4%. We will give you 4.5%. Why are they doing this? Well, they want to gain market share, right? They want to, take market share from the banks. But stable coins are not a speculation. I mean, you're essentially buying $1 for $1, right? I mean, it's no different than a money market account. I did say, essentially it's a digital blockchain money market account. But stable coins are not guaranteed to sit at $1. They do fluctuate in price. And when you want to sell a lot of any one stable coin, let's say you want to sell it for Bitcoin, you want to sell it to buy Ethereum, you want to sell it to buy the crypto that I'm mentioning. Yeah, if you go to sell large amounts of it, these prices hover in and around $1, but they're not exactly there. And if you go to sell it all at once, especially during periods like this when there are panics and people are scared and worried, sometimes people will, the markets will get illiquid and suddenly you can't sell it. So it's a place that is perfect for blockchain, smart contracts, automated market making, which essentially just, uses machine language, et cetera, to try and extract the maximum amount at the cheapest price. In other words, when you go to sell, you want to get the most at the lowest price for the lowest. You want to get the most when you at the highest price for the lowest fee. And there is a exchange that is sitting on the Ethereum blockchain primarily, and it is called Curve, right? Curve is a crypto token, but it is also a crypto platform. And it is a crypto platform that only trades stablecoins. There are many different stablecoins. There are several hundred stablecoins. Like some of them, the biggest one is called Tether. It has something like, I don't know, a couple 100 billion, I think, in it. Then there's Circle, which is the second largest one. PayPal, for one example, has issued a stable coin. Robinhood is planning to issue one. Banks are planning to issue their own. In other words, we've got even more stable coins coming. I can see a future in which every bank has their own stable coin, and they're all competing. And that means they also, when large amounts of these stable coins have to be bought and sold, you can't just go and exchange it for cash or a dollar. You kind of have to go and trade it. And the most liquid market for these stable coins is on this Curve platform, right? So we can see something going on in the short term, which is that even through this difficult period here, one of the things you'll see is that Curve is finding buyers. It's finding buyers, meaning that people are following the news about stablecoin, more issuance. As I told you, like every bank is planning to issue one, Fidelity's planning to issue one, Robinhood's planning. In other words, there's billions of dollars going to come in. There's estimates for, over $1 trillion to come into stablecoins over the next 3 years or so. That means huge trading volumes for an exchange that is the dominant primary place where, the liquidity for this happens, right? So their trading volumes would go up, which would generate a lot of fees, which would then drive demand for this token, right? That is sort of like the process by which things go up. So we are seeing the first signs that buyers seem to be interested. We had this rally here in March, and then, into this meltdown, you're seeing that, it's not really going down and taking out this new low. In other words, there are buyers willing to come in, let's say in and around 40 cents. And why are they doing this? Well, because the trading volumes on Curve are exploding higher. They're hitting records. Why? Well, there's more money coming into stable coins because, of course, the chaos in stock markets has also driven chaos in crypto markets. So people have been selling Ethereum, selling Solana. And what are they putting their money in? Stable coins, right? So the market for stable coins is rising. There's more money pouring in There's more people wanting to sell in quantity that's driving trading volumes higher on Curve. And you can also see this. You follow this story here, which is that developer activity, in other words, people that are using the Curve platform, has jumped to an all-time high, 927. And you can see this is from 2020. This is an all-time high. So that's a very positive sign that people are planning to follow through on their stable coins, and they're integrating Curve into their plans. And here is also a market signal, which is the long-short ratio. In other words, people betting on Curve price to go up versus go down is starting to reflect people's viewpoint that stablecoin issuance is going to be good for Curve. It's going to be good for trading on Curve, and it is going to push the price higher. So bottom line to this, which is that, yes, there are lots of things that are going on, but there are also bull markets that are emerging. I mentioned some of them in like the stock markets. There's bull markets in electricity, drones, gold, insurance. I think, will be joined by general crypto. But in the crypto markets, beyond Bitcoin, the stable coins is a bull market, meaning that there's huge amount of stable coins that are there to be issued. The demand is rising, which means the demand for trading them is going to go up. That benefits this token that really dominates stablecoin trading. And it's already hitting record highs. And the market is showing signals that they understand this, they know this. In other words, they care. If they didn't care, they would be selling this thing down and it would be sitting there, and all my analysis really would be worth nothing. In other words, what they're showing that they're willing to buy. Even today, they're bidding it up 9%. So I would tell you, Curve is one that, hey, not that it couldn't go lower, but there is definitely a bullish scenario going on for the underlying asset that this exchange. And what this is, Curve is a stable coin exchange. I mean, there's an underlying bull case for stable coins, which ultimately is a bull case for Curve. Now it's trading for something like 46 cents. And if I go back to this, I mean, it does not reflect any long-term optimism. I mean, this was at $6.80 back in 2022. And we're now, still under 50 cents. How high could it go? Well, it depends on how fast we get stablecoin issuance and how much trading starts to explode out onto Curve. Because remember, in the end, a exchange like Curve is largely a fixed cost. And so the first amounts of volume will pay for the cost. And eventually, the vast majority of that, trading generates fees, but there's no expense related to it. So it'll start to drop down to the bottom line. In other words, Curve's fees are going to explode higher. And with that, everybody will be like, I need to own Curve. The fees are exploding higher. The volume's exploding higher. Stablecoins issuance is higher. Everyone in. All right. That is my Investment Tuesday for today. My view of the tariff, panic, crash, sell-off, correction, whatever you want to call it. My viewpoint on Bitcoin, because there's a major event, which is a transformation of Bitcoin going on. And then third, one crypto that in some ways, is benefiting from the general chaos and troubles that are currently going on in all markets. All right. Quick plug for ATG Digital. That's the website, atgdigital.media. And with that, I'll say thank you for watching, and I'll be back next Tuesday. This is Paul saying thank you and goodbye.